Afternoon, everyone. Thank you for joining today's session. We're actually kicking off this session with a variety of sessions where we're going to go through a deep dive of getting started with options. So today's session is the ultimate guide to getting started with options. So it's really the most beginner options webinar that we provide. So we'll go into a lot of details as how options vary from stocks, what they're used for, understanding risk versus reward. So it's something that you can perhaps utilize within your portfolio. If you don't know me, my name is Jessica Skip. I'm the Director of Education and Product here at OptionsPlay. And we're partnering with First Trade to just bring you these educational webinars. And at OptionsPlay, it's something that we focus on is education first. So we certainly appreciate you joining today's session. And of course, before we get started, we always have to start with just a quick disclaimer. Know that we're not going to pull up any real securities today, but oftentimes we do talk about them and know that they are purely for demonstration purposes only and not a solicitation to buy or sell or recommend any type of strategy. Options are complex. They require, excuse me, losing my voice a little bit today. They are complex and they require an additional amount of features, and that complexity means that there is, of course, additional risk that is involved. And then from a first trade perspective, know that options do involve risk and they're not suitable for all investors. OptionsPlay is a third party that is not affiliated with First Trade whatsoever. And so just take a moment to read these disclosures. And if you haven't seen the something that we call the ODD or the characteristics and risks of standardized options, it's a document that I'm going to put within the chat. If you've ever traded options before or applied for options, you've certainly have seen this document before, but it's something that the OCC distributes that essentially goes through the characteristics and risks of options. So the anatomy, so on and so forth. And it's important to be aware of that prior to trading options and of course, whilst trading options. All right, so let's talk about the goals that we're going to talk about today and our objectives. So we're going to start with what an option is and how it works. So we want to understand the components in the anatomy of an option. That way we can have our basic foundational essential information on the anatomy of an option. If you get lost, it's okay. We're going to cover this really in a 4-part series, so we'll revisit that type of information. Second, we're going to talk about the differences of stocks and options. They tend to fall in separate buckets, as do stocks, as do options. And we're going to go through that detail. And then we'll shift over to why one would trade options and the different investment objectives that are aligned to your option strategy, and some examples of strategies that would fall within those buckets. And then lastly, we'll finish off with the tools and resources that are available to you. And of course, some best practices that I'd love to leave you with as we talk about trading options. So starting with what an option is. So an option is literally a contract. It is a contract between a buyer and a seller, and it has terms associated with it. So think about any type of contract that you've ever experienced in your life. That contract, when you hit the I agree or you sign on the dotted line, there are terms associated with that type of agreement. So if it sounds like there's a lot of legal jargon, that's because there is. But my job is to make sure that we simplify those complexities so you fully understand it. So it is a contract between a buyer and a seller. The buyer pays for that contract. So they own that contract, which means they have the rights of that contract. They can execute upon the terms of that contract. The seller is obligated to fulfill those terms of that contract. So in this example, this contract, the terms are 100 shares of ABC. There is a $100 price associated on a per share basis. And this contract is executable at any time until the expiration date of March 24th of this year, so about 30 days from now. So that means, and then the contract is issued as a call or a put, and a call simply means contains the right to buy, or a put means it contains the right to sell. Back in early Series 7 days, I always remembered that as call up and put down. So lots of fun little sayings. So that means that if this is a call option and I'm the buyer that I paid a premium for, I own the right to buy, which means I want ABC to go up well above $100 per share as much as possible before this contract expires, which is March 24th, 2023. So the difference is this has an expiration date attached to it, and it has terms attached to it, whereas stock does not. And we're going to dive deeper into that. And puts are really just the opposite, but I wanted to make sure you at least had a foundational understanding before we dive into the nitty gritty details. So another way of displaying or discussing the anatomy of an option is just the questions that we ask that are associated with any type of contract, which is what quantity are we agreeing on? What's the product that we are agreeing on? What is the price and what is the time frame? Notice the word agreeing on. So that's there, therefore it serves its purpose. So the quantity is the contract amount. On our previous example, we had one contract, but you notice within the terms, it represented 100 shares. So that's generally how options work, is one contract always represents 100 shares, controlling ownership of 100 shares of either buying or selling. The product is the underlying security, and that can be a variety of things. It can be a stock, it can be an exchange traded product, which means a note or a fund, an index, a currency, even a commodity, or even futures contracts. Lots of products that can be associated with it. The price that you're agreeing on, that term is just a strike price. So when we say, oh, I'm buying an option at this strike, that just means that this is the price that I am agreeing to buy or sell the option at, or obligated to if you're on the other side. That's priced per share. So you noticed on the previous example, we had one contract representing 100 shares at $100 per share. So the strike price is always per share. And the time frame is just the expiration date. This is when it ceases to exist. Normally expiration is on Fridays, but as technology has progressed, so has the expiration cycle. So less liquid options, which means options that don't trade as often or have as much volume associated with it, tend to only have Friday expirations, whereas other options that are very, very liquid or have a lot of volume associated with it have expirations sometimes even every day. Great example is the SPX or S&P 500 index options. They are literally a cycle that expires every single day, and that's just for an example. So in other words, that would be the way we would see that is one ABC $100 March 24th 30-day TE until expiration option. That's the way we would display it. And if I see this on my screen or our position list, I would know that I've got one option that represents 100 shares of ABC, so 100 controlling shares of ABC at $100 per share that expires by March 24th, which is within the next 30 days. So it's my coupon or my contract that contains these terms. And just like we said before, it's issued as a call or a put. The call simply means the right to buy, and a put means the right to sell. But when I teach, I always want to make sure that you put this in your mind. Whenever someone says the word call, always in your mind say the right to buy. Same with put, the right to sell, exactly in that order. So if you say long call, long means purchased. We say short, short means sold. So just like you would stock, you long stock, you've purchased stock. You're short stock, you sold stock. So if I'm long a call, that means I purchased the right to buy. And if I'm long a put, I purchased the right to sell. If I'm short a call, I sold the right to buy. And if you're on the sell side of options, you're on the obligation side, which we'll go into a lot more detail later on within this series. Whereas if I sold the put, now I'm obligated to buy. So you take the other side. But it's really, really helpful just focusing your mind when anytime you hear the word long, you say purchase. Anytime call, the right to buy. Anytime short, you hear sold, and then put the right to sell. So just keep that in your mind, and that will really help clarify. Options can be exercised, and all that means is you're executing upon the terms of the contract. So if this contract up here was issued as a call, then that means executing upon the terms of that contract means that I'm going to buy 100 shares of ABC at $100 per share. So that's why we say controlling ownership. At that point, your option ceased to exist because you executed upon the terms of that contract and you own 100 shares of ABC at $100 per share. No matter where the market is pricing ABC at, you get to buy it at $100 per share because that's the terms of the contract, which means you obviously want the market to be at well above 100 per share, 150 per share. Because if you have the right to buy at 100 and could go to the market and sell at 150, that's got to be a valuable option. That's if you're buying the option. So it's where it's important to understand how these work. They could expire, and they do expire because they cease to exist and stop trading when that expiration date occurs. So in this example, if March 24th comes along, come 4 o'clock Eastern time, that option is going to stop trading. There are different trading hours with other types of options. But generally, it's 4 p.m. They can be traded, and that is more common. So you buy and sell options on the marketplace, on the secondary market, just like you would stock. A market has to exist, which means someone has to take the other side of it. There's a lot of details that go into that, which we'll talk about in the next session when we talk about how an option is priced. But that priced is referred to as a premium. So when that option is bought and sold, it has value. And that value that you see or that you're willing to buy the option at is called its premium. So those are just some terms associated with options. And I wanted to give you a quick anatomy of what an option looks like before we dive into their different uses, different investment objectives, so on and so forth. Now we'll introduce you to this T-chart. You will see us utilize this quite a bit. Now this is what we call the basic version of the T-chart. And we actually build this out all the way to the Greek because essentially options are a mirror image of each other. And if you can utilize this chart and learn long calls really, really, really well, you can figure everything else out with the use of logic. And so we want to introduce this as slowly as possible early and often. That way you can fully grasp options, because it happens to everyone when we teach options. It turns into a light bulb moment. At first, it seems like so much information, and then all of a sudden it clicks. And so we do our best to make sure that we give you those type of light bulb moments. So the way that this is set up, we have calls on the left and puts on the right. And we always start with long calls on this top quadrant. And then we put short calls below it, short puts on the top upper right-hand quadrant, and then long puts below it. And then what you'll notice is whenever we buy an option, we have the right to execute upon those terms. Whenever we sell an option, you're obligated to take the other side. So meaning if I purchased the right to buy 100 shares of ABC at $100 per share, I have the right to execute upon those terms at any time that I want as a person who is long or purchased the right to buy in this scenario, so the long calls. On the other side, for the short call, I receive the premium from this long call holder. However, I'm obligated to fulfill the terms, which means if they want to buy at $100 per share, someone has to sell it to them for $100 per share. And that's me, the short call holder. So that's how we say it's there's a mirror reflection of each different strategy. And what you'll notice is this is also color coded. Bullish strategies are found at the top and bearish strategies are found at the bottom. Bullish strategies either contain the right or the obligation to buy, but either way, there's a purchase associated with it. Whereas bearish strategies contain the obligation or the right to sell. So there's a selling transaction associated with it. So it's about as deep as we're going to go to as the basics of options. And if you've never seen options before, I would absolutely highly expect you to be extremely confused at this moment. But what I do need you to take away is there are some more complexities when we're dealing with options because there is an expiration date. You purchase for a premium, which means we've got to talk about price and components, which we'll talk about, of course, in our next session. And I may be bullish or bearish, I'm even neutral, and you can layer these together. And so that's what we're gonna talk about, how each of these strategies can fit into those different type of investment objectives that are found with options when you add that complexity onto your portfolio. Options can be longer term, they can be shorter term. There is so much associated with it depending on your outlook. So it's important to understand and put education first. That's definitely the first step. So moving on, let's talk about the different types of stocks. I'm going to take this step back. Whenever you learn about stocks for the first time, there's a third component here that I didn't call out, but I'll make sure that I give that to you. We tend to put them in two separate categories, and the third is being value. It's not here, but growth and income. So growth is something that tends to have a higher PE ratio, for example. That means that someone is looking, the investors are willing to pay more for earnings. So that tends to be the tech sector. That's a growth sector. Think because they require a lot of innovation. So they have those higher type of PE ratios. So that's just the way I want you to think about the way we can relate this. If you have a growth stock, they're not really intended for income. So they tend to not pay dividends. Sometimes they do, but they're not as much. But the reason for that is remember, a dividend is a share of capital. And if you're sharing out that capital, if you're not, then the other aspect is you should be reinvesting that back into the company to have profits. So that's the difference really, primarily of growth and income. And those are for the investors that are seeking capital appreciation. And sometimes it requires a little bit more of a risk profile. And there's a lot more data that goes into that. But, and know also there's lots of difference with PE ratios that we can certainly dive into. But what I want you to take away, there are two different types. On the income side, there tends to be a lower price to earnings ratio. That literally means price divided by earnings. Because it's not expected to have as much growth, it tends to pay a dividend because it's giving you an income stream and the company distributes those profits to you, which is that form of a dividend. And that's for the investor that is seeking investment income. And then of course, there's that third value that's not displayed on here. Now, if you're a stock trader, sometimes you're going to have a combination of this on your portfolio, or you might find a stock that seeks to do both in a way, or you may venture out to preferred stocks. There are lots of other aspects, but these tend to be different depending on where you are within your investment journey. And options can fit in buckets similar to this, but you're adding, and this is why I'm calling it a layer, like another layer to the cake, is these are your underlying positions that you're going to utilize for options. But there's some differences that you have to know because you can absolutely seek growth utilizing options and or income or a combination, depending on how you structure it. Even utilizing the underlying security and owning the stock or adding to your longer term portfolio. There's a lot more that goes into it, but it's important to know, even as you try to identify what's found within growth versus income, it's almost a similar process. And I hope that makes sense and I didn't confuse you more. But what I wanted to take away from this is there are different stocks, there are different investment objectives for everyone. And it all depends on your risk profile, your risk tolerance, if you are willing to accept losses in the long term for growth. Long term, great example is, again, Facebook. They had to do a lot of changes, or Meta. It's so hard for me to change to Meta, but there was a huge issue last year, and a decline in the security because there was a lot of investment in the metaverse, which was a future anticipated earnings. So hence it had a higher PE ratio that eventually came down. So that's an example of growth versus income, an extreme example that has to reshift, but there's other components that go in price influences of stock versus options. So those variations are important to understand and can translate certainly over. All right. Now let's take a look at differences of stocks and options. So there are certainly some differences. If first and foremost is, or the main two that we want to talk about is ownership and price influences. So if you own a stock, your goal is capital appreciation. You want to buy that stock and you want it to go up in value. And that you want that in addition to a dividend. Those if your income, so growth versus income is where that's important, where your goals align. But generally speaking, you want to buy a stock and you want to go up in value. If you own a stock, you are entitled to those dividends as long as you own it day before the exit. And you are also entitled to voting rights, which means you can have a bit of influence on the price influences. And you can theoretically hold that stock indefinitely unless it goes bankrupt or something like that. But theoretically, you can hold it forever. Whereas with an option, you can have various outcomes and goals. Options can be aligned to various time horizons. They can be short dated, it can be long dated. You can use options with stock that you already own to protect or to generate income. They do not entitle you to dividends whatsoever because you own the right to buy or sell the stock. You don't own the stock, which means you're not entitled to have any voting rights or to receive any dividends unless you literally take ownership of those shares, which is then puts you right back into this category, the stock category. And options can be profitable in a bullish, bearish, or neutral outlook. They can also be very unprofitable in those outlooks very quickly as well. So the layer of complexity equals increased risk, and it's important to know what those are. The price influences of stocks also vary, but directly affect options. So that additional layer of complexity. Stocks are influenced by earnings. So if earnings beat expectations, then that means, and we have really great future guidance, they're telling us the next 3 months or next year looks really, really great, that stock's going to go up in value. And if there's increasing revenue, that stock will generally go up in value. There's really good management decisions. That tends to go on the expense side, which all contributes to earnings, which makes stock go up in value. Another great example of that, Meta must be on my mind right now, is when Mark Zuckerberg came out on the earnings call and said, hey, this is the year of efficiency. And he unfortunately made some layoffs, but that allowed him to focus back on profits. And a lot of what's happening within the tech sector, again, for example only, that is an example of management decisions that influence the price of the underlying security. So if you believe in efficient market theory, essentially as information comes to light, then that means that the price will adjust accordingly. You can apply whatever type of analysis you want or have a process to stocks. That's entirely up to you. Traditionally, it's technical and fundamental, either or a combination of both. It tends to require a larger capital outlay, meaning you've got to put up a lot more capital in order to buy 100 shares of that security if we're looking at it from that comparison. And it has a symmetrical risk profile, stocks do, meaning that if you invest in a security and for every dollar that stock price goes up on the market, you are also making a dollar. So that's that symmetrical risk profile. Whereas with options, there are other influences because now we also rely on this to understand our sentiment of the underlying security, because we know with options, we can be bullish, bearish, or neutral. So our sentiment of the underlying security from a stock perspective is defined based on this. But we have increased complexity because now volatility is a component of it. If earnings is coming up, for example, because we've added a time value component, there's a likely movement of this underlying security or that stock moving up or down in either direction. And because there is a likely movement, an increased likelihood that the option will be more profitable, tends to make it more expensive. We call that implied volatility. The textbook definition of that is the market's pricing or likelihood of an anticipated movement in either direction. Time also adds a price influence to it. Time is always working against us. So certainly can't go the other way, no matter how hard we try. But as the option nears expiration, it also depletes in value. And that makes sense. If I have the right to buy something at $100 per share that expires tomorrow versus the right to buy that same security at the same price at $100 per share that expires a month from now, the one that is a month from now is going to be more expensive than the one that expires tomorrow because it has more time to be profitable. So that has an influence. And then, of course, interest rates and dividends also have an influence as well. Normally that's on longer dated options, and then 9 months or more. That tends to have the biggest influence on interest rates. If you run calculations, it tends to be very, very minimal, but it's important for you to know that there are other price influences that affect options other than just that what it affect the underlying security. But everything that you find on the bottom quadrant actually do affect options. And that means it has an asymmetrical risk profile, because as the stock moves up $1, your option does not move up $1. It actually varies because there's other factors that affect the options price than just the underlying stock. It's volatility, time, and interest rates. And all you need to take away from this is, if I'm venturing into options, I know that it can fit a variety of different investment objectives. I can have different goals and outcomes. People utilize them because it requires less capital outlay. We can create an income stream off of it. But there are complexities when you add this layer of complexity. There are risks associated that we want to make sure you're aware of. So let's take a look at the 3 main reasons why investors trade options, and then we'll give you some examples within each of these categories. So first and foremost is speculation. That's where you take a directional view of the defined limited risk. So I'm buying a call or a put, and I am assuming that the underlying security is going to move drastically in my favor. So drastically up or down. And it's limited risk because I don't have to spend as much as buying 100 shares of the underlying security. It tends to be a fraction of the cost. And when I'm purchasing options, the most that I can lose in that situation is the amount that I spent. Just like when you purchase stock, the most that you can lose is the amount that you spent. That's only when you're purchasing options. There is absolutely unlimited risk potential for naked options, which we're not covering today, but it is possible. So please know there are differences. The second is income. So that's where you create yield on an existing portfolio or a position. So a lot of times it's so interesting when people start trading options. They tend to start here, buy calls and puts, take directional views, or they start here and stay here, or they end up coming here to the income side, which is where you utilize the obligation found within options. So really the other side here, so you selling the options to create premium off of stocks you already own, or stocks you want to own. And I'll give you a little example of that within the next slide, and we'll of course cover that on a later session. And then the third is hedging, and these are primary. There are of course other ways to layer options, but this is where you protect downside risk on an existing portfolio or positions. Because if you're purchasing a put, you have the right to sell. So it's for hedging purposes. If you owned a lot of Apple, for example, and you were unsure about a specific time frame, you could technically buy the right to sell Apple at the current price or whatever price you're comfortable with. And since you have the right to sell during a certain time frame, that means if the underlying security moves well below that strike price, you still have this contract that allows you to sell that stock at a certain price. And that's a way to protect during a time frame, because remember, there's an expiration date, and of course you have to pay for that protection. That's one form of hedging, and we'll go through a little more details. Let's dive into speculative trading. This is where we have the long call and the long put. So I put a chart up here just to give you an idea of when I would want to do this. So first and foremost, if you're speculating, you're looking for a directional view. You are thinking that something is going to move up or down directionally. So if I thought something was going to move drastically upwards, then I would purchase a long call. That's an example. And if I purchased a long call, remember that means I purchased the right to buy, long purchase, call, the right to buy, which means I absolutely want the underlying security to go up in value as much as possible because I have the right to buy at a lower price than what the market is. And then the inverse is true for a put. That just means a long put. That means I have purchased the right to sell. So if I have the right to sell at this around 140 right here. Well, if the underlying goes all the way down to 100, it's got to be worth at least 40 bucks because I have owned the right to sell at 140 and the market is trading at 100. Therefore, the difference of those two has to be at least what my option is worth. So that's an example of speculative strategies. Is when you purchase options individually, you're purchasing the right to buy or the right to sell. You own that right to buy or sell through the terms of that contract. You may not necessarily execute upon those, but the option should move in value based on those terms, which again, the next session that we're covering will be going over how an option is priced. And an important component of that, though, is both of these strategies are defined risk. Because if I'm purchasing something, the most I can lose is what I spent. And it tends to be a fraction of the amount that I spend versus 100 shares of the same underlying security. The risk, though, is always a trade-off, is you're adding complexity. There's an expiration date, which means you can't hold this option forever. It's going to lose value much more quickly than the underlying security because of those other pricing components. And that's really important to know. The next is income trading. Now I've got two examples up here, which is a covered call and a covered put. And a covered call just means that I am taking shares that I already own. So if I own 100 shares of, say, this security at 140, and I'm bullish, and I want to create an obligation, because remember, the long call is I purchased the right to buy. The short call means I've sold the right to buy. If I've sold the right to buy, I'm obligated to sell. The way that you cover your position, the short call individually is an unlimited loss potential because you're obligated to sell the shares at the strike. If the underlying security goes to, say, 180 per share and you don't own it, you'd have to buy 100 shares at theoretically infinite price, but say in this example 180, and then sell at the strike price at 140 or whatever your strike price is. That could be a really large loss very, very quickly. And individually, a short call is a bearish position. But what a covered call is now you're creating an income stream and you are covering that position by already owning the shares. So say you owned it at 120 or 140, you have to own at least 100 shares and you create the obligation to sell the shares at the strike price. That's still a bullish position because you expect the underlying security to go up because you have stock at this point. And then if the underlying security moves above your strike price, then you're just going to sell at a profit at that point. And then you cap your profit potential. The exchange, always a trade-off, is you have no more capital appreciation above your strike price that you've selected. And that's a strategy we're going to go into a lot more detail on the next session. And a cover put, literally just the opposite, which I'm not going to go into too much detail of, but it contains the obligation to buy. So that's covered by the amount of money required to purchase those shares. Both of these are sold options positions, which means you collect a premium. And covered calls are probably one of the most common because you would do that off of an option, a position that you already own. So your risk when you purchase a stock is how much you spent. You sell a call. So say we purchased it at $100 per share. We'll do it on a per share basis. And now we sold a call at, maybe we've done it consistently, but now it's at 140 and you've decided you're going to sell a call at 155 and you received $2 per share for that. So that's an additional $200 that you'll receive. That's your income stream. And if this moves up to 155, you still make that $15, but then you're just obligated to sell your share. So that's how options can be used for income on a portfolio that you already have. It's just by utilizing the obligations that are found within options. And again, we have a session that we'll go into a lot more detail with. So it's utilized for yield on existing options. Both of these strategies, a covered call and a cash covered put, are bullish because you make maximum profit when it moves upwards. And a lot of that also depends on strike and strategy selection, which we'll talk about and when we go into strategy specifics. And what you're doing is just creating an obligation to buy or sell the underlying through the contract terms in exchange for a premium. And that premium is what generates the yield on your portfolio. Now let's talk about hedging. I gave you that example a little bit earlier, but it's intended to reduce risk on owned positions or even options. And a lot of this is utilized by creating what's called a hedged put or by creating a spread. So a spread is where we have multi-leg options because you can utilize, if you have an obligation and you want to mitigate unlimited or substantial risk potential, you can do that by having an offsetting long position, which is more advanced options trading, but nonetheless fits under these investment objectives. But the intent from what's put on the screen on the long put is it protects profits on your long-term investments or you're reducing your risk exposure. So for example, if you've purchased a stock, say perhaps at, again, $100 per share as on this chart, and you were afraid that the market was going to downturn and you weren't sure for how much, and you wanted to protect yourself during that time frame, you could purchase a long put. So you've purchased the right to sell at a specified price for a specified time frame. So even say 140 or 120, wherever the lower the price, the less expensive it's going to be, which makes sense because the right to sell at 140 is much more valuable than the right to sell at 120. So therefore, I would protect my gains to whatever strike I selected. So in this example, if it was 140, even if this underlying, so meaning I purchased a put with the right to sell at 140, even if this underlying declines well below $100 per share, I would still own the right to sell at 140, which is how options are utilized to protect any downside risk for a specified period of time. Those cover the three main reasons why one would trade options, which is speculation, income, or hedging. Options are certainly complex. They are used for a variety of reasons, and definitely appreciate you taking the time to understand that. What I do want to make sure we cover lastly before we open it up for questions is some best practices. So if you're trading options for the first time, here's really your keys to success or to start with. And first and foremost is start with education. Get engaged in your trading process, understand the strategy. It's the key to optimizing trading because if you understand what the ins and outs of your strategy, which is what the next sessions will cover, then you'll know what obligations you have, what risks are associated with it. So you'll be able to fully understand what will happen in every scenario. And that's extremely important. You do not want surprises. And just think about it. It is an investment. Anytime you're purchasing a home or you're purchasing a car or a big investment, in my mind, it's even a purse. You do your research. You understand if that's the neighborhood you want to live in, or if it's something that will go up in value, if it's a short-term need, or maybe something that you're going to move on later on, or even if you're renting, you have a process. You should have a process as well when you're trading in general. And also, especially if you're trading options, because you're adding a layer of complexity. That's why it's important to know how your strategy works in and out, because then you can understand, okay, this strategy is most profitable. I'll use that example of the long cost. I purchased the right to buy. The underlying moves up as much as possible, which means that I need to make sure that the sentiment or the underlying that I'm trading that strategy on, that long call on, matches the way I feel about that underlying security. And then in addition to that, I need to define a process that helps me understand if something is bullish or bearish or neutral. I need the stopping point. That's why layering on technical analysis is extremely helpful when we're trading options. We have our fundamental view, which gives us an idea of future anticipated growth, if it's perhaps overvalued or undervalued. But the beauty of technical analysis is it gives us starting and stopping points based on supply and demand. So, for example, knowing for that same speculative strategy where I'm purchasing a long call, yes, it has unlimited gain potential through a specified time frame, but is it going to make an unlimited gain potential within that time frame? No. There is going to be a point at which it's going to reach its highest level, and technical analysis can help you define that. So that's one example of aligning your sentiment to a process and then fully understanding the strategy that optimizes from there. Third is utilizing your tools and resources. At First Trade, there are a variety of tools and resources, and that aids your process, meaning you have reports that give you ideas and starting points. You have the OptionsPlay wizard, which is designed to give you ideas, validate your sentiment, and then focus on risk versus reward. And you can even compare a stock to buying a call or versus a covered call. So extremely important from that perspective is utilizing all of your tools and resources that are available, inclusive of education, but as well as those idea generation tools that are just complementary to you as being an account holder. And probably the most important, I would say, is having a disciplined exit strategy. This is in general when we have the word trading associated with anything, is having a process, and that process is inclusive of entry and exit point. Meaning when we develop, we know our strategy inside and out. We've decided that we're bullish on something, we've validated it with our process, and we think it's going to stop at a certain price. We've utilized tools to validate our sentiment and process, maybe even define it. But if we're wrong or we hit that stopping point, we need to make sure that we exit that trade and then move on to the next one. Trading absent out of emotion is extremely important. Think about, again, if you are making a big purchase of any way, shape, or form, you've done your homework. You are being calculated. You're not going to impulse buy a home. It's very hard to do that because of all the terms that are associated with it. Much easier to do that with options because of technology and it's accessible to you. Those terms, you just agree, boom, done. Therefore, it's important to just understand or add that layer of discipline. And that's probably the hardest thing to do. But if you do that and you have a holistic process, then you will certainly maximize your results. One of the greatest sayings I've heard, I would say last year was, though, remember your process isn't a process if it isn't profitable. And that's important to know. But nonetheless, I want to make sure I left you with that. And then we can open it up to questions from here. So feel free to type those into the chat window or within the Q&A. We've got about 15 minutes for that. And again, thank you for taking the time just to understand how to trade options. Know that there are risks involved. There is a completely separate approval process that is required before trading options. Usually pretty rare you don't get questions, but that's okay. Either you did a great job or you're very confused. I do encourage you to come to next week's session. We're going to build on this and we'll talk about options pricing. And then followed by that, we will talk about more income producing strategies and really focus on those single-legged options. I did get one question from Justin. Okay. So from Justin, would buying leap calls and puts and then selling shorter dated calls and puts be one of the best ways to hedge but generate income. Remember, hedging from downside risk means, if in that sense, as if you already own the security. There are a couple different strategies that you were defining there, Justin, which is a calendar spread. So that's a whole different strategy. That's absolutely something that's possible, and it is a very common way to generate income. I wouldn't say that it's necessarily hedging. You could with buying puts and then selling puts at a lower strike. That's a way to reduce how much you spent on hedging. So there's lots of ways to layer that. And then of course there's a collar too. But to answer your question, yes and no. And I hope that answered it fully. Is it possible to see a trend of options prices? So you certainly can. You could chart an options price, but I don't recommend it, because an option, unlike a stock, when it starts getting really far away from its strike price, then it doesn't trade as much, which means you're going to have an erratic price. So if you want to understand options pricing, you need to chart the underlying security. You can utilize the Greeks to understand the effects of the other options, and you can do that with a variety of factors. And we'll have another session where we'll cover that. So if you're looking to, if you're very analytical like I am, and you're trying to understand some processes around how those different variety of factors will affect options, it's not charting the options price, it's charting the underlying security and then understanding the Greeks and how they affect that price. And that's a really great session that we'll cover in a lot of detail. We can certainly discuss credit spreads. I will add that to our list, and we can go over that in more detail. Thank you, Corey. Mag asked a question: inside an IRA account, is it possible to buy a long-term expiration leap options and then selling short-term leap options? That is considered marginable, is what I'll call it, because you have a short option associated with it. And even though you're offsetting it by a long dated position, you're essentially creating a calendar spread or a horizontal spread, diagonal spread, excuse me. And the spread aspect is what makes it a marginable trade. So that tends to require limited margin in the IRA or some way, shape, or form of margin. So yes, that is a marginable trade. And margin does require a lot more risks associated with it. No problem. All right, so that looks like all the questions. Again, I appreciate you taking the time to go through and understand options. It's definitely the first step. We're focusing this year on sessions that build upon one another. So know that our next ones are going to be just an extension of this. So thank you again. I hope everyone enjoyed this session. Has a wonderful week, and we will see you soon.